All right, today we're diving into a really interesting way to think about investing in the future of the internet. We're talking about the Bitwise Web3 ETF, which trades under the ticker BWEB. And the key thing here is that it's all about the companies that are actually building Web3. So, to really wrap your head around why Web3 is such a big deal, you got to look back a little bit. First, we had Web 1.0. That was the read-only internet, basically just static websites. Then came Web 2.0, which is pretty much where we are now. It's the read-write web of social media, but, and this is a big but, a few giant companies own all the platforms and all our data. The whole idea behind Web3 is to be the next leap forward. Read, write, own. It's a vision for a decentralized internet where blockchain technology lets us, the users, actually own our digital stuff. So if you believe this is the next major shift, the question that naturally follows is, well, how do you invest in it? How do you get exposure to the potential of the next version of the internet itself? And here is the single most important thing to understand about an ETF like BWEB. This is not about buying cryptocurrencies like Bitcoin or Ethereum directly. Nope. This is an equity ETF. That means it invests in the stocks of the companies that are building the tools, the platforms, and the infrastructure for this new Web3 world. And that brings us right to the main event, the Bitwise Web3 ETF, BWEB. So let's pull back the curtain and really dig into how this fund is designed to give investors a way to participate in the Web3 theme. Okay, let's look at the vitals. The ticker is BWEB and it trades on the NYSE Arca. It's still pretty new, having launched back in October 2022, and it has an expense ratio of 0.85%. So, it's a fairly standard setup for a targeted thematic ETF. And here's how the fund itself frames its mission. They define Web3 as this major evolution that uses blockchain to build a more open and decentralized internet, one where we don't need to depend on just a handful of big tech companies acting as the gatekeepers for everything.
I know I'm repeating myself, but it's that important. The fund's own documents make this crystal clear. They do not invest directly in cryptocurrencies. It's a pure equity play. It's about the companies, not the coins.
So if it's not holding crypto, then what's actually in the portfolio? What kind of companies are we talking about here? Let's pop the hood and take a look. Okay, this is cool. This is how the fund carves up the Web3 economy. The biggest piece of the pie goes to Web3 infrastructure. You can think of these as the picks and shovels companies building the foundational layers. Then you've got the metaverse, Web3 finance, and the creator economy. It really shows you the different angles they're taking to capture this whole theme. Now, when you look at the actual top holdings, you'll see a lot of names you know. We're talking about major publicly traded companies like Shopify, Meta, Roblox, and of course, Coinbase. Take Shopify, for instance. Why are they in here? Well, they're building tools for creators to sell digital assets like NFTs, which plugs them directly into that Web3 creator economy. So these are big, established players making serious moves in this space. And it's not just about the familiar names, it's about their size. Would you look at that? Over 80% of this fund is invested in large and mega-cap stocks. So this isn't some grab bag of tiny speculative startups. It's actually anchored by some of the biggest tech companies on the planet. So how exactly do they decide which companies get in and which ones don't? Well, the fund follows a pretty unique, rules-based strategy they call their pure play approach. Let's break down how that works. It all comes down to this tiered system. They sort companies into 3 buckets. Tier 1 companies are the pure plays. Their entire business is basically Web3. Tier 2 is for companies where the majority of their business is tied to Web3. And then Tier 3 is for those diversified giants that have significant public plans for Web3. But here's the kicker. That rule at the bottom is what really matters. At every rebalance, at least 85% of the fund must be invested in those more focused Tier 1 and Tier 2 companies. Of course, anytime you're looking at an investment in an emerging, potentially explosive theme, you have to talk about performance. But, just as important, you have to talk about risk. So let's take a clear-eyed look at both the potential and the pitfalls here. Looking at the numbers, well, the fund had a monster year in 2023, up over 98%. But, and I can't stress this enough, that is past performance. It gives you absolutely no guarantee of what will happen in the future, especially for a new fund in a sector that can be this volatile. And look, you don't have to take my word for it. The fund itself is extremely direct about the risks. This is a quote taken straight from their own prospectus, and it warns investors to be ready for a high degree of volatility and the possibility of significant losses. You can't get much clearer than that. The prospectus digs in even deeper. You've got the risk that these emerging technologies just don't take off like people hope. There are risks tied to the blockchain technology itself. We've already hit on volatility. Then there's concentration risk, putting all your eggs in this one thematic basket. And passive risk, which just means the fund is going to track its index, for better or for worse. And that really leaves us with the billion-dollar question at the very heart of this whole thing. Is Web3 truly the next great tech revolution, something on the scale of the internet itself? Or is it the next great bubble? The answer to that question is ultimately what will decide the future for an investment like this.